Good evening, everybody, and welcome back to another class on synthetics, by the way. Today, we're going to be starting with stacking at specific points, and we're going to be looking at current price actions of some of the synthetic pairs. Now, you remember that in yesterday's class, I introduced synthetics in general, where I talked about some of their volatilities and the recommended pairs that you can stick to when it comes to some of the recommended pairs that you can stick to when it comes to account sizes below 500. All right. Now, the major advantage that synthetic indices has over currencies and the cryptocurrencies, I mean, when I say currencies, I mean the forex currencies and the cryptocurrencies, right, is the fact that synthetics is a 247 market. You know that um for forex currencies, the market closes on Fridays. Even during the days, I think it closes like 9 p.m. Then resumes 11 p.m. There's like a pause at the end of New York session before Asian session opens, right? And then Friday closes completely until Sunday midnight or Monday before it opens. So it operates just like Monday to Fridays only. But when it comes to the synthetic indices, it's 24/7, right? And unlike the crypto indices that has their price action tied to BTC. When I mean tied, I mean correlation, right? Most of the alternate coins that you see, alternate coins are like every other coin that is not Bitcoin. So like the Ethereum, the Solana, the whatever cryptocurrency, so long as it's not Bitcoin, it's an alternate coin. So these alternate coins, they are usually majority of them are tied to BTC's dominance, which means that you can have a good market structure now. Let's say a buy market structure. And just because BTC is selling, your buys will get invalidated on other alternate coins. So most of BTC's movements, most of these cryptocurrencies are tied to what BTC is doing. And that is why you see when BTC is experiencing a retracement, let's say there's like a sort of a bear run, that is price going towards the downside on BTC, you would realize that most of all these alternate coins also would experience this price movement to the downside, whether they were in an uptrend or not, right? So that's like the correlation between BTC and alternate coins. But when it comes to synthetic indices, nothing is the same there. Everything is independent. You can have 75S buying and then you have what 100S selling, or you can have 10 buying and you have what 150 selling. Do you understand? They are all what independent on their own. They are not tied to anything. They are not correlating with anything. It is what independent pairs, independent markets. Another thing is that the synthetic indices market does not, like, news does not affect it. Do you understand? Unlike the currencies that you hear that okay, the CPI, Powell is doing this and that. Like most of these what do they call it? Core news events, right? Unlike the synthetic, there's absolutely nothing like news there. The volatility is just there 247. All right. Now, this volatility makes it easier for you to stick to the higher time frames on synthetics, right? Because unlike the currencies that, let's say, on the 4 hours time frame, in a month, you're seeing like just three valid demand zones or four, right? When you go to the 4 hours time frame on synthetics, in a month, you should be seeing enough. Do you understand? So it makes it easier to stick to the higher time frames here on synthetics compared to currencies. You know, like currencies, it said that okay, let's be doing the 1 hour and validating on the 4 hours for better trades and still in line with the higher time frame goal. But then on synthetics, if you decide to get your POIs on 4 hours and any of that, you still be what's in line and you still be what's in track. Well, for me, my most important time frame when it comes to synthetics is the 1 hour time frame. I usually love to deal with the 1 hour time frame. When it comes to stacking as well, I stack on the 1 hour time frame. All right. But then remember that when I taught you guys confirmations, when we had a class in confirmation entries, if you remember very clearly, I talked about pattern confirmations and candlestick confirmations. And I also mentioned that the candlestick confirmations are what I love to use on synthetics. And I told you guys how to use this candlestick confirmation. Now, if you remember what I talked about, I said that the most important candlesticks when it comes to confirmation entries is what number one is the pin bar. The pin bar is for what? A bearish retracement. All right. When you have something like this, right? A bearish retracement just like this. I said that this is one. Number one candlestick confirmation, and then the inverse, which is what the hammer, which is just like this. All right, we also talked about the hammer, and then we talked about what the bullish engulfing candlestick, right? And then the bearish engulfing what candlestick, and then we talked about what the reversal candlestick, which is what the doji candlestick. Now, for this particular stacking and specific points, you're going to be needing the what the engulfings, which is what the bullish and the bearish engulfing candlesticks. These are your focus when it comes to what stacking at specific points. These are what your specific points. All right. Now, before I start stacking on specific points, I mentioned in yesterday's class that we are going to be experiencing what we're going to have three types of entry models. Yeah, remember in when we're talking currencies, as the crypto and the forex currencies, I mentioned that we have what type A, which looks like this. The price takes out a low, pulls back into 50% to put in what a structural high again, and then comes back to what mitigate and buy, which gives us our typical type A entry model, right? And then I also mentioned that there's what another type, which is what our type B, or if you're going to call it type 1 and 2, it's still the same thing, all right? And I talked about type B, which looks like this. Price giving you what the inducements before breaking out, and then comes back into the entry and then puts in a new high, something like this. Now, when it comes to synthetics, you may not always see sweeps on the higher time frames. I mean, time frames above 1 hour. That is where you're going to only employ this type C, which looks just like this, right? So you may not always see sweeps on the higher time frame, and that is where this our type C comes in. Something just like this. Now, if you remember when we did demand and supply zones, I told you guys that for demand zones, they may not necessarily be what? They may not necessarily be sweeps. Where I now talked about that in the case whereby there's no sweep, there should be what? There should be an order flow mitigation. But then I told you in currencies, you should always look for what sweeps. Now, when it comes to synthetic indices as well, if you're dealing with time frames below 1 hour, you must always what? Look for sweeps. Even on the 1 hour as well, there should be what sweeps. But if you're going to the 4 hours time frame to look for your point of interest, you can afford to do what? Order flow mitigations. All right. And this order flow mitigation is based on the fact that price mitigates the first entry and then gives you what? A confirmation on that entry. So that confirmation may not necessarily sweep liquidity, but it is mitigating a previous demand. So you need this order flow chain for you to take trades like this, right? In case you're not seeing a type A or a type B, this is what a typical type C, where there may not be a sweep, but there must be what a continuation, like let it be a mitigation of a previous demand zone. If possible, let that previous demand zone mitigate another previous demand zone. Like let it be what an order flow chain, just like this, more like creating what a trend line, right? Something just like this. This is what the type C entry model looks like. Now, for synthetic, I prefer to use candlestick confirmation, although there are times whereby you can also use pattern confirmation, right? More like when you're done with the first trade and then price is coming back to confirm the second trade, you can use what pattern confirmation, so long as it meets what your type 1, 2, or 3 entry model. But then for confirmation, For confirmation entries, if you're going to be using the candlestick confirmation entries, make sure that whatever you remember our 5 types of what confirmation candlesticks, any of them that you're going to be using, they must have closed above your entry. More like if they mitigate your entry, they should what close above before you start placing your buy or your sell orders. For something just like this now, let's say for this particular trade now, you have let me use another one. Let's use volatility 10x. Okay, so here we have commit me, let me see, 15 minutes. I'm trying to look for mitigation and entry and then explain what I meant by closing above. All right, for something just like this now, on the 15 minutes time frame, sorry, on the 1 hour time frame now, this is a mitigation to this entry. All right, and then you can see that as price mitigated the entry, you're not setting your limits down. All right, when you're trading synthetics, you're not setting your limit down, which means that it is as price approaches entries and does what closes, gives you a confirmation candlestick. If you're the one to be using a confirmation candlestick or no pattern, price has to what give you a confirmation candlestick in this case, and this is a hammer candlestick, right? And so that hammer candlestick, you can see that it closed what above your entry. It should close above your entry before you decide to what place that trade, which means that if this hammer was created inside of this particular setup where price is yet to close above entry, something just like this, it's not a confirmation yet. Do you understand? You would need one of your confirmation candlesticks, whether the engulfings, the pin bars, the hammer, the doji, or whatever, to what close above your entry before you say that that setup has been confirmed. So even if your confirmation candlesticks are found within the zone, they are not what confirmations yet until one of them what sprouts above entry and closes what above the entry. So in this case, it has to be what something like what this hammer did. Gave you a confirmation, a hammer on your POI, and does what closes above entry before what you start placing your buy positions. So your confirmation candlesticks inside your zone is not a confirmation yet. So did they do what? They give you a rejection above entry, more like showing you that buy pressure, that okay, we're buying now. Do you understand? That okay, we're buying now. Now, let's start with stacking at specific points. Now, specific points, like I said, when it comes to stacking at specific points, the most important thing when it comes to stacking at specific points is what is the engulfings. And here is how stacking at specific points is. You understand that the market is very volatile. I mean, the synthetic market itself, it's very, very volatile in the sense that there's a 247 generation, which causes either buys or sells continuously in the market. So there's always what's movement and constant volatility in this particular market. Now, if price should mitigate your entry, all right, and let's say after this mitigation, it's not always a straight one to your take profit target. There are going to be what retracements in between. More like price can be doing something just like this, and something just like this, all right, before getting to your take profit targets. Now, if you decide to stack at a point like this now, let's say this kind of point like this now, and price should retrace, like have this sharp retracement to the downside, you agree with me that most of the money or the margin that you used to open a trade at this level that you trace back to this point, you're going to have it lost. And that is why you see people blow their accounts before price even takes them out, right? People blow their accounts before price even takes them out. It is due to the issue of what stacking randomly. So if you're ever going to stack on synthetics, it has to be what? It has to be stacking on engulfings. Now, here's the thing about this engulfing, not just random engulfing. Remember when I already taught you guys how to set what your 50% Fibonacci 2. So you're going to be needing your Fib 2 or your gun bus that is already set like this with 0, 1, and 0.5 settings. All right. So let's say you have a setup just like this. Let's say you have let me set, okay. Let's say this is the first entry now. This is a type A entry model before the confirmation entry. So let's do something with this one first. So let's say you have this first setup, and then price mitigates your entry, going straight for your take profit target. Let's just say you're targeting this previous high. All right. Let me just target somewhere here. Okay, let's say you have a setup like this. Now, the first thing you have to do after having your setup on synthetics, right, is to pick out your Fibonacci tool from your stop loss, whatever zone you're using at your stop loss, which means that even if your stop loss is at this level, right, or your stop loss is at this level, whatever zone you're using as your stop loss, you're going to be marking out from that level, which means you're marking out from this level here now to your take profit targets. All right, something just like this. You're marking out from this level towards to your take profit targets. Now, the entire idea of stacking is that when you're stacking, when you're buying and you want to stack, all your stacking positions must be done what in this first 50% of price leg. This is the first 50%. That's from 0.5 towards 0 in the case of buys. But then if you're going to be selling, let's say this is just an assumption. Let's say you're selling from this area now. Okay, let me just look for something like a downtrend. So let's say you're going to be selling from this area now, this zone. Place your sell to stop loss, maybe this level, and then take profits, probably this level. Now, if you're going to be selling, here's what you're going to do now. The same thing, you're taking your Fibonacci 2 or your gambas, just something you can use to mark out 50% from your stop loss, whatever your stop loss may be. This one is relative, whatever area you set your stop loss towards your take profit targets. Now, every of your stacking is going to be done what in this first 50% here, 50% level, because you're selling. But in the cases of when you're buying, it's going to be done what in the second 50% leg, which is what in this particular level. So when you're selling, when you're buying, your stacking is done what in discount, and when you're selling, your stacking is done what in premium, just like that. All right. Now the thing is, when you're done with your analysis, and then you map out 50% using your Fibonacci tool between your buy and your sell positions, you've mapped out 50%. The next thing you'd want to do now is to look out for price. The first stacking point, your first stacking point at any time is what your entry. Your entry is your first starting point, and this is why. It's because your entry is the cheapest that you're ever going to find price. All right, your entry is the cheapest that you're ever going to find price. So it's more like at your entry, you want to be opening up to 40% of positions that you'd like to open. Let's say in a particular trade setup, if I have $100 to risk on that setup, let's say this is a $1,000 account, and I want to risk $100 on one trade. Now you understand that my business is what with the risk, the amount I would like to lose if my trade should what hit my stop loss. Now, if I have $100 to lose on a particular trade setup in a $1,000 account, what I mean by my entry being my first starting point is that my entry is going to be the point at which I open more positions, more starting positions. All right, because your entry is the cheapest that you're ever going to what buy an asset. More like this. Remember that in this case now, this is the entry. But then as price mitigates your entry and price is going, you'll be what having higher prices. What you will buy at this point now, at this point 0, is going to be cheaper than what you buy at point 1. It's just like the price of something. Let's say this is a pen now. This is a pen, and then at this pen now, this is 20 naira, this is 30 naira, this is 40 naira, this is 15 naira, and this is what 16 naira. Just like if you look at my the right side of my screen, you're going to see what 8541. And the next thing you see is what 8550, 8560, 8570. You would realize that as you proceed or as you progress in an upward way, the price is what's increasing. 85580 to what 8590 to 8597, right? Which means that as it's going up, it is becoming what more expensive. So your entry is the cheapest that you're ever going to buy. Let's say for somebody that wants to start a fish farm, or let me say you want to start selling bios, all right? But then you have only 20 naira to buy that pen, right? You have only 20 naira to buy that pen. Now you're going to buy one bio because that is what you can afford now. In a $10 account, now you may not necessarily have enough money in a $10 account to open multiple positions yet. All right. So you'd have to open the one that you can afford to open. But then as that position is getting into profit, like as that position is becoming giving you profits already, you now want to stack with your profits. So the whole idea of stacking is better in the trying to open more positions with already existing profits. All right, like that's why I think Dr. Falodun, I was a $4 account that he moved to, like, was it 700, I mean 1,200, I can't remember, and then a $200 account to $7,000, right? Now, the whole idea behind that is at first now you can realize that I think the lots were like 4,444. It should be like whether I don't know, was it maximal on that particular pair? But you realize that on a normal day now, that $200 account wouldn't have been able to accommodate all of those stacking, right? Accommodate all of those increased loss size in stacking. But then when you are in profit, that your profit is adding towards your balance. So it's just like when you have $20, you have what a 20 naira pen, all right, and then you sell that pen for what 15 naira, just like this, all right. Now you no longer have 20 naira, you have what an additional 30 naira, which means that you can buy what two more pens, right, what 20 naira each. It's just the same thing as when you have a $10 account and you open a trade at your entry, and then that particular trade enters, like that particular trade is already in profits. Now your profit is reading as part of your margin, which means that you can now open more positions with your margin. So the entire idea of stacking is what being able to open more positions with your profits. You did not have like enough money to open these positions at your entry. So you open the ones that you can afford to at entry, and then as price is progressing, when you are in profit, you're now opening what more stacking positions. All right. But then, like I said, your entry is going to be the cheapest that you would ever find price. And that is why you're going to buy as much as you can at your entry, which means that up to 40% of your entire risk is going to be what's opened at entry. Up to 40% of your, sorry, I don't know why this is touching. All right, up to 40% of your entire risk is going to be what's opened at your entry, which means that if you have $100, a $1,000 account, and you want to risk $100 on a particular setup, right? On that setup now, you're going to open $40 at entry, and then you will spread the remaining $60 at specific points, all right? Which means that if you have $100 account balance now and you want to risk only $10 to stop loss, right? You're going to spread what your $4 at entry, and then what happens? The remaining one will serve as margin for the other specific points, just like that. So whatever your risk is at entry, you should be what opening up to 40 to 50% at entry, 40 to 50%, and all other positions should be opened at what? All other positions should be opened at other specific points. All right. So your entry is your first specific point. Your entry is that level at which, okay, price has mitigated your demand zone or mitigated your supply zone of your analysis, and then you've gotten a candlestick confirmation that closes above your entry in a demand scenario or closes below your entry in a supply scenario. You've gotten that confirmation closed, and then what's the next thing you do? The next thing you do is now to what? go to your MT5 and execute that trade. Now you see that execution, that first execution you're doing is what your entry, right? That's your entry. And so my point now is that at that entry level, if you're going to be risking $1,000 on that setup, you're going to what open up to $400 to $500 on that particular level. If you're going to be risking $5 on that setup, at that entry level, you're opening like 2.5 or $2 already, and then you're going to what spread the remaining risk along with other specific points. Now, the major reason again behind opening up to 40 to 50% at entry is because of the fact that some pairs are very volatile. There are times where when I've traded like the volatility 10s, especially. This is a very volatile pair, very beautiful in terms of its run to the upside. Right, you can have this pair, like this pair does not consolidate. You cannot say the same for something like 150s, that you can have a pair consolidate multiple times in your entry until the day it chooses to break out. All right, but some of these pairs, they have like a very straight run, so it's not all of them that would give you what specific points to stack on. Some of them will just mitigate and run straight to take profits. All right, so you don't want a situation whereby you didn't enter with enough position sizing. All right, so at every time, remember that your entry is your first starting point, and your entry is going to what accommodate 50 or 40% of your entire risk. All right, and then the rest of them is going to be what spread at other specific points. Okay, so let's look at these specific points now. I told you that no matter where your take profit target is going to be, which is like, let's say in this particular case now, this particular buy, let's say you are targeting this overall high. Although when it comes to synthetics, I love to mention that I recommend targeting next highs or next lows, like next demand or next supply zone. If you're buying and you see something that looks like a demand zone, sorry, if you're buying and you see something that looks like the supply zone, just put your take profit before the supply. Don't negotiate on whether higher highs and higher lows, all of that, because most of these supplies and demand zones, considering the volatility that comes with synthetic indices, you can have internal demands and supply sending price up and back down, something just like that. And that is even why you're not stacking in the premium, right? When you're buying, or stacking in the discount when you're selling. Because the moment you leave the first 50% of your setups, they are what? They are buy side demand zones, supply zones waiting to send price back down. Like here now you have this hidden supply zone here. What I mean by hidden supply zone, you see this particular type of, I don't even think I talked about hidden supply zones when I was talking about demand and supply. All right, but then if you look at something like this now, whereby you have 2 weeks crossing, just like this, you have this week and this week crossing just like this. If you go down to a lower time frame, this is what's going to give you a supply zone on the lower time frame. Like let's go down to 15 minutes. Let me show you. All right. So you notice that when price is already getting into the premium, when you're buying, it starts creating supply zones. But when price is already getting to the discount when you're selling, it starts mitigating demand zones, making most of the setups. Now you can see this is what it looks like on the lower time frame. That thing that looked like a cross, you can see that it is an entire order block on the 15 minutes time frame. That's a hidden demand zone. So when you have crosses like that, overlapping weeks on higher time frames, say like 4 hours, 1 hour, when you go down to like 15 minutes, 30 minutes, you realize that they are supply zones just like this. They are order blocks. All right, they are order blocks just like this. This is what they look like. But when you go back to the 1 hour, it just looks like it's an imbalance. All right. When you go back to the 1 hour, you can see what it looks like on the 1 hour time frame. But on the 15 minutes time frame, it's an entire order block. Okay, so back to what I was saying. Now, when price is already leaving the first 50% of price leg, just like this, it is already having supply zones ready to send it back down. And that is why you're not stacking above this first 50%, because you can stack at this point now. Let's say, engulfings can be formed at anywhere on the chart. whether 50% or not, you can have engulfings from what any point in the chart. And that is why I don't recommend what stacking above the first 50% when you're buying, or stacking below the second 50% when you're selling, because you can have an engulfing candlestick now form at this level, and then what happens, because a particular supply zone price is reacting temporarily from a particular supply zone, what happens? It retraces in a bid what takes you out, and maybe may still go your way. All right. So when you're stacking, you understand that it is, of course, going to be what increased profits, yes, because multiple positions, multiple money, but at the same time, you're going to have what increased risk as well. So whatever you want to do, you want to stick to what the first 50% and second 50% what principles. So let's look at some of the recent price actions on some of these pairs. And the first one is going to be what? The volatility 10S and volatility what? Okay, volatility 10S. This one is 10S. Now, when it comes to volatility 10S, I told you that when price mitigates your entry, the next thing you want to do what is mark out, or sorry, when you have a particular entry already, you're done with your analysis, you're going to mark out from your stop loss to what, to your take profit target, wherever your take profit target may be. You're marking out from wherever your stop loss is to wherever your take profit target may be. Now, when you've marked out something just like that, please just give me like a minute to take all of this off. All right, thank you. So as I was saying, when you're done doing the Fibonacci thing from your stop loss to your take profit target, the first thing you now want to do is what? Okay, price has mitigated your entry and closed above your entry. You have what? Your entry as your first what? Stacking points. Now, this entry as first stacking point is going to have what? Your normal position stop loss. Or let me just talk about stacking points and then talk about stop losses by stacking in the next class. All right. So now this is going to have your normal position stop loss. And then when it comes to stacking, you're definitely going to be using what the engulfings, and it must be a proper engulfing candlestick. You see what happened here? This particular two candlesticks here now. These are not engulfing candlesticks. Let me see if I can expand my screen. So these are not engulfing candlesticks. This is not an engulfing candlestick. So this is not what a stacking point. Your stacking point should be what proper engulfing candlesticks for something just like this. This particular one, like what happened here now, this is an engulfing and it is what a stacking point. I'm just trying to help you recognize these engulfings first. We're going to talk about how to stack with them. But for now, right? So here we have what one stacking point, and then you can see that price did what? Price now went above the 50% to do what? To now continue before what retracing, which means on this particular 10S, you had only what? You had only one stacking point before price left 50%. And that is what I talked about. I said the 10S and the 10, they are 10S and 10. They are very, even 25S and 25. I think 10S, 10, 25S and 25, they usually provide like, let's say, one or two, sometimes none stacking point. Sometimes the only stacking you have is what your entry itself, and then price just don't mitigate and then go straight to entry. That happens majority of times. All right. But then you see pairs like 75, 100S, and 5S, 100 itself, like this one, 50S as well. Right. They're volatile enough that you can even have up to like 6 stacking points in the first 50%. All right. But for pairs like this, it can just be only one. Like you can see now, this particular confirmation. Now, this confirmation was what? With the pattern confirmation. Now, you can see that with price mitigated entry, what happened? We had a sweep of liquidity whereby price went down to mitigate this point. And then what happened? They swept liquidity at this low and then did what? Created these inducements before what's breaking out to take out this previous lower high. So in this case, we have what our typical type B entry pattern as our what confirmation pattern. Okay. Now having this type B as your confirmation, what happens? You are going to what? Set your entry at this level, and then your stop loss wherever you want it to. If you want it to cover the entire low, fine. If you want it to be what at this particular zone, fine. But when you're done making your analysis, like in the case of confirmation like this, what you do next, you take out your Fibonacci 2 from the first 50% to the second, from your stop loss, to what your take profit target, wherever you're targeting. Even if you're targeting this particular supply zone now as the external, wherever you're targeting is fine. But then in this case now, where this is the target, this is what you're going to be doing. Wherever your stop loss is to wherever your take profit target is, your stacking must be done what in this first 50%. This is where your stacking should be done, this first 50%. And now in this case, you can see that what happened, price came, mitigated our entry, which was with this hammer candlestick. Now, when price closed above the entry with this hammer confirmation pattern, what happens next? You're going to what? Go to your MT5 and open your positions with what? 40 to 50% of your entire risk. And then the next thing you're waiting towards is to see an engulfing before you enter. Now, on these engulfings, I look out for them majorly on the 1 hour time frame. No matter the time frame that I get my POI from, even if it's the 4 hours time frame that I get my point of interest from, my stacking is always done on the 1 hour time frame. For times whereby I have pairs that are lagging, like there are times whereby I'm trading like 250s, and then you have 250s like consolidate, even the 150s. The 150s is a very useless pair. I stopped trading it a long time ago. All right. But then let's say in the case where you have a 250s that is like consolidating an entry before going to your target to all of that. For something like that, I prefer to do my stacking on the 2 hours. So if you have too much consolidations on your entry, like something like this now, what happened there is some sort of consolidation. You switch to the 2 hours time frame to look for your stacking at that particular time frame. It becomes clearer. Like in this case now, you can see that we had the entry create what this was your first stacking position, which in this case is what is an engulfing. This is the first stacking point. This is what the second stacking point in this case. All right. But then when you go back to, but then when it's a clear price action, I just do it what on the 1 hour time frame. The only reason why I switch to the 2 hours time frame to look out for this engulfing is when I think the 1 hour time frame is what ranging a lot, and I don't want to have multiple deceiving engulfings. All right. But in this case, now you can see that this was a clear price action. Price gave this hammer candlestick and then came backward to create what an engulfing, which is what my stacking point. Now, I've not taught you guys how to stack on this point yet. So just in case somebody wants to ask, I'm just trying to make examples first. Now, the second one, let me look at if I have anything marked up on 10S. All right, on 10 itself, sorry. So this is volatility 10 index. It's just like the twin of what do they call it? Just like a twin to 10 itself. All right. Now for something just like this, now you can see the movements. Here we have price mitigate this particular supply zone. All right, and then this is a confirmation to that supply. In this case, this is like a type A internally, right? For confirmation entry, price took out this low, then took out this low, created this adjustment, and there was like more like a sweep of this entire range before the taking out of the lows. So it's just like a type A confirmation pattern, all right, on the 1 hour time frame. And then price mitigated, and you can see the pin bar rejection. All right. So what you're going to do when you have this type of analysis is to take out your Fibonacci 2 from whatever zone your stop loss is towards whatever zone your take profit target is. Now, every of your stacking level is going to be done in this first 50% because you're selling. So this is going to be where every of the stacking is going to be done. Now your entry is your first stacking point, which means that as price closes below your entry, this is like when the hammer candlestick closes below your entry on the 1 hour time frame, this is going to be your first stacking point. All right, this is your first stacking point. Now the engulfings that are going to be created in this first 50% are now going to be your continuation stacking points. In this case, now you can see that we had only one engulfing candlestick being created on this time frame. which is what this particular point as what your second stacking level. Although there was what an engulfing at this point, if you go down to the lower time frame, I already taught you guys how to. I just mentioned, sorry, because I don't think I did that before now, that this overlapping of weeks are what there are other blocks on lower time frames. Okay, so at this level now, you could have had like another block on the lower time frame, but I prefer to stack on the 1 hour time frame, or if need be, on the 2 hours time frame. So instead, I just do what I just wait for the engulfings on the 1 hour instead of using the overlapping candlesticks. All right. So in this case, this would have been what the second starting point. Because of the volatility of this 10 and 10s and 25 and 25s, most of the times you won't have like above 3 stacking points on them. So whenever you're trying to open positions, have into consideration that what you may not have up to 3. Sometimes it can be only 1 stacking point on them. All right. I'll still teach you guys how to stack. I'm just talking about how to recognize where to stack first. How to stack is going to still come. All right. Now let's look at, I think there should be something on 25S. Okay. Let me go to 25 instead. Let's go to 25. Now this is a current trade on 25. I think I even saw somebody on the trade idea group. Was it the winning trade subtopic of this particular setup? All right. Now, first of all, this was the demand zone that price was reacting from. I told you that sometimes they may not necessarily be what they may not necessarily be sweeps. It can just be order flow mitigations. But then let's look at what happened here. Now, in this case, price mitigated this particular demand zone. All right. That may not have necessarily been a high probability demand. You can see there was no order flow chain, not really. But then you had what you had price mitigate that level and then give you what a pattern confirmation. This should be like a type B confirmation on the lower time frame, maybe on the 15 minutes, right? This is the inducement, and then price mitigates this and then starts buying. But then just in case you're skeptical about whatever happens there, you have to wait for what price to give you a proper retracement move before entering. So this may not have been your ideal entry, but then you try to what catch the continuations to see if you're going to catch what better confirmations. Now in this case, what happens? Price takes out that inducement level, which is what this point here. This was the inducement level that price took out. And then what happens after taking it out? We had what our sweep, and it goes ahead to put in a new high and then pulls back to do what create an inducement level before what's coming back to the upside. Now in this case, we have our type A entry model, which is what the sweep, the same level going to put in a high and all of that. All right, giving us what our typical entry. Okay, and then price after you're done analyzing something just like that, you're going to place your Fibonacci tool from your stop loss level towards your take profit target level, wherever your take profit may be, whether you're targeting internal highs or net supply and demand. But I already told you that when it comes to synthetics, right, you don't want to be on the rough side of this volatility. Okay, so what you want to do is to make sure that when it comes to targets, you're targeting what's next supply is next demand. Like for something just like this, I don't think my stop loss would have exceeded the level like this. Sorry, my take profit target would have exceeded the level like this, or even maybe this one above here, because they have the tendency to send price back down. So you want to be targeting next demand level, next supply level, because this internal demand and supplies can actually send price back down. They are that volatile. All right. So when it comes to this 25 and 25S, I told my student that like a start that I usually sometimes have to go down to the 30 minutes time frame to look for stacking positions on them for 25, 25S, 10, and 10S. This is because they are very volatile in the sense that price can mitigate. You can see what happened here now. Price mitigated this entry. And next thing we experienced was what they went to the upside, like almost left the discount and then started doing this on the premium. All right, you just have something just like this. It's that fast that you may not even see a stacking point that is not what your entry. So if I feel like at entry, I didn't stack enough, I would just go to like 30 minutes time frame to look out for stacking points. but then it is of lower probability, and that's why I didn't want to mention it in this class. But then it's still something that you can try out. It's something that I do that still works at times. It's just like how you have your type A and your type B. That type A is a what of higher probability than type B. That's the same thing here. Stacking levels on the 1 hour are way better than looking out for stacking on the 30 minutes time frame. But just because this particular, like these 4 pairs, may not necessarily always give you your stacking levels on the 1 hour, sometimes you can switch down to the 30 minutes. Just if you think you didn't stack enough at the entry at your entries, maybe that's why you can switch down to what 30 minutes. In a case like this now, there was no what stacking points in this my level because my target was what crazily little. For somebody that would have been targeting, let's say, an external high, let's say for something just like this, somebody that I targeted would have got it to something just like this, maybe they would have been able to catch some of the stacking points that price created in this particular level. All right, because here you had what your first engulfing candlestick here. At this point, these 2 candlesticks, you had another engulfing candlestick, which should have been what the second level engulfing, and then before price was eventually broke out of the discount. So it could have been what any of this. But doing this is like more risky than just waiting on the 1 hour. So for this particular 25, 25S, 10 and 10S, I can just literally do